Have you ever watched the market break a level and then whip straight back in the opposite direction, leaving traders stuck on the wrong side of the trade? Then that's a fake out, and it's one of the most misunderstood yet powerful moves in trading. In this video, I'm going to cover what fake outs are, why they occur, then how to recognize them, and how to use them to your advantage. So let's get into it. Just a reminder that Forex trading is risky and that most traders lose money. This video is for educational purposes only. So what is a fake out? Well, a fake out or a false breakout is basically when price moves above or below a key level, but quickly reverses direction and leaves breakout traders trapped. But here's the thing, not all fake outs are created equal. What you want to look for is fake outs that happen at key areas of interest, where the broader market is watching. This means that you're not choosing random lines on a chart. You're looking for areas where you may have a prior high or prior low, strong support or resistance, psychological round numbers, major trend lines, or neckline zones in chart patterns. These are the areas where traders place orders, algorithms fire off trades, and emotions run high. And when price fakes out of these levels, it does not happen in a vacuum. It meant that the market tested the sentiment and found no support for the trade. And that's exactly where we as traders will find our edge. So the key takeaway here is to only trust the fake outs at levels that other traders care about. So why do fake outs happen? They basically occur because of liquidity and trader psychology. And here's usually what's going on behind the scenes. The big players push the trade beyond a known level to trigger stop losses. Retail traders jump in thinking it's a true breakout, but instead of continuing, price snaps back. This is sometimes called a stop run or a liquidity grab, and it's something I covered in a previous video, so you can go check that out. The link will be below. And it happens all the time, especially during major news events or at session opens. But if you're patient and you wait for confirmation, fake outs can actually become reliable signals, not traps. And that's where things get interesting. So what is the fake out sequence? Well, here's the pattern to look for. Number 1, price approaches a key level. Number 2, it breaks through with momentum just enough to trigger stops. Number 3, it stalls and then reverses sharply. And number 4, often you'll see a strong wick, an engulfing candle, or a spike in volume. This moment of rejection basically tells you that the market tested that level and then rejected it very strongly. And that's your cue to start planning your trade in the opposite direction. Okay, so here we have the Euro USD on the hourly chart. This is the Pepperstone TradingView trading platform. And here the market was sitting above a well-defined support level. It broke below that, and everyone thought that a deeper move was coming. But here's what happened next. A bearish candle pierced the level, and the very next candle was a bullish engulfing candle, and the market reversed with a huge rally. Now, this is a textbook fake out, and one that traders were obviously watching globally, and everybody was seeing the same signals. If you'd waited for confirmation, instead of chasing the move, it would have been a high reward opportunity. So how do you trade fake outs? Well, firstly, you have to be very patient and disciplined, as I mentioned earlier, and you've got to wait for that confirmation. So number 1, you're going to mark key levels ahead of time. You're going to mark your highs, your lows, trend lines, or round numbers. You'll then let price break that level, and you're going to observe how it behaves. Number 3, you're going to wait for the rejection. So you'll look for a wick, a reversal candle, such as an engulfing candle in the opposite direction, or a sudden spike in volume. Next, you can use a filter. So you can use the RSI or the MACD or moving averages or the VWAP to confirm what you're seeing. And you're going to enter on the confirmation, not on the initial break, as we saw earlier. You're going to place your stop just outside the fake out's high or low. Then you're going to set your profit target at a 1 to 1.5, 1 to 2, or 1 to 3 risk-reward ratio, depending on the market. This approach basically filters out all the noise and helps you to avoid making emotional decisions. Now, I just want to give you a few advanced tips and confirmations that you can look for that a fake out has occurred and when you should enter the trade. Firstly, look for volume confirmation. The fake out candle should always have a volume spike. Next, you're going to look at wick length, and I think this is one of the most important indicators of a fake out. So the longer tails often show a stronger rejection. Next, you can look at RSI and MACD divergence. So, for example, you may see a new low in price, but you don't see that new low on the indicator, and this could indicate a reversal is about to occur. And then momentum ignition, probably one of my favorites. This is when price reverses and then accelerates very quickly, and it's quite easy to spot as well. Thank you so much for watching. If you have any questions, please don't hesitate to contact us at fxscouts.com or alternatively contact us in the comment section below. And please remember to subscribe if you're not subscribed already and like the video too. Thanks so much.